CTS Corporation, ticker CTS. Q2 2026 earnings are officially out, and it is a massive beat across the board.
It's a huge beat.
Right. Revenue clocked in at $144.8 million. That is up 7% year over year and up 4% sequentially from the first quarter.
And the bottom line is even crazier.
Yeah. Adjusted diluted earnings per share hit $0.74. I mean, that completely crushes the $1.57 they posted in Q2 of 2025.
A 17-cent jump is, well, it's no joke. And the market reacted exactly how you'd expect.
Exactly. And management, they aren't just taking a victory lap here. They actually raised guidance.
Across the board, yeah.
Right. Full year 2026 sales are now projected to hit a range of $565 million to $585 million. And that adjusted EPS bumped up to a range of $2.55 to $2.70.
Which is really the signal Wall Street looks for, right? When you see top-line growth, sequential growth, and like you said, a massive 30% jump on the bottom line all in the same quarter, people pay attention. Raising that full-year guidance confirms that this isn't just, some temporary pull forward of revenue or some one-time accounting quirk. It signals a real structural improvement in how the business operates.
Okay, let's unpack this. Because for you listening, just knowing the headline numbers, that's only step one.
Right. You need the context.
Exactly. We need to figure out the how and the why. So to do that, we are diving into the Q2 earnings call, the press release, and management's forward-looking commentary for this deep dive.
It's a really interesting story, too.
It is. Imagine building like a multi-million-dollar defense satellite or the life-saving medical device. And its success hinges entirely on a tiny sensor or an actuator the size of a coin.
Yeah. A single point of failure?
Right. Historically, CTS has been known as an automotive parts supplier. But when we look under the hood at these Q2 numbers, they're acting a lot more like a high-tech defense and medical components firm.
The narrative shift is just profound. And I mean, it's backed up by the math. Management refers to this as their diversified end markets.
Which groups together industrial, aerospace, and defense, and medical, right?
Right. And as of this quarter, that diversified group now accounts for 59% of their total revenue.
Wow. So it's officially the majority of the business.
Exactly. The script has flipped,
Yeah.
and sales in that category jumped 15% year over year.
And if we break down that 15% jump, the medical segment is it's the absolute star of the show.
Oh, without a doubt.
We're looking at a 45% year-over-year increase in medical sales, up 14% sequentially. And they posted a book-to-bill ratio of 1.21.
Which is incredibly aggressive growth for hardware.
Right. Management cited sustained demand for diagnostics and therapeutic products, but, 45% growth. Why are they suddenly dominating this specific space? Are they just, undercutting competitors on price?
Actually, it's the exact opposite. They were winning on complexity, not price. Let's look at the actual mechanism behind these medical components.
Okay, lay it on me.
CTS manufactures things like piezoelectric ceramics. Piezoelectric. Basically, in plain English, these are materials that generate an electric charge in response to applied mechanical stress, and vice versa.
Oh, okay. So where do you actually use that?
They are the core technology inside, say, ultrasound imaging machines, or the microactuators used in really precise drug delivery pumps.
I see.
If you are manufacturing a therapeutic device that physically pumps medication into a patient, that actuator cannot fail. The tolerance for error is absolute zero.
So the customer is paying a premium for reliability, basically.
Yeah.
Because the stakes are literally life and death.
Precisely. But it goes even deeper into the regulatory mechanics of it all. The medical device industry operates under incredibly stringent FDA regulations.
Oh, right. The red tape.
Yeah, massive amounts of it.
Right.
When a company designs a new diagnostic device, they have to submit a detailed design history file to the regulators.
And CTS is baked into that file.
Exactly. Once a specific CTS sensor or actuator is designed into that device and approved, the switching costs become astronomical.
Let me make sure I'm following this. You're saying if that medical company wants to save like 50 cents by buying a cheaper sensor from an overseas competitor, they can't just swap it out on the assembly line.
They absolutely cannot. Swapping a core component often means they have to go through a massive recertification process.
Oh, wow.
Yeah, they have to prove to the regulators that the new part performs exactly identically to the old one. The administrative and testing costs of doing that, they far outweigh the 50 cents they'd save on the part itself.
So once CTS gets engineered into a therapeutic or diagnostic device, that revenue stream becomes incredibly sticky.
Very sticky. It creates this powerful moat with significant pricing power.
Which perfectly explains how you can print 45% growth without crushing your margins.
Exactly.
Now, keeping with the diversified group, industrial also showed some really solid momentum. Sales were up 16% year over year.
And up 6% sequentially.
Right, and they pulled in a book-to-bill ratio of 1.11, plus they added 2 new customers this quarter.
The industrial performance is crucial here. It proves the diversification strategy is broad-based.
How so?
Well, if medical was up 45%, but everything else was totally flat, you could argue they just got lucky with one big healthcare contract, you know?
Ah, yeah, one-hit wonder.
Right. But seeing 16% growth in industrial automation and commercial equipment, that validates that their engineering solutions have real cross-sector appeal.
Right. But then we hit aerospace and defense. And at first glance, the data here looks terrible.
It's surface, yeah.
A&D sales were actually down 15% year over year. Before I read the rest of the report, I really thought the aerospace division was bleeding out. Why is management treating this segment as a win?
What's fascinating here is the difference between a trailing metric and a leading indicator. Yes, recognized revenue was down 15%,
Right.
but management explicitly noted this was just due to the timing of contract awards, which is super standard in government and defense procurement. For you, the investor, the metric to obsess over here isn't recognized sales.
Right, it's the backlog.
It's the book-to-bill ratio and the backlog. Exactly.
Because they posted an A&D book-to-bill of 1.23, and total bookings were up 48% year over year.
Let's break down why that 1.23 number is a massive flashing green light.
Yeah, let's do it.
Book-to-bill is simply the ratio of new orders received, the bookings, compared to the revenue actually billed during that period.
So a ratio of 1.0 means you are replacing your revenue exactly as fast as you bill it.
Right, so a ratio of 1.23 means for every dollar of product CTS shipped out the door, they received $1.23 in new orders.
Okay, so demand is vastly outpacing their current billing capacity.
Exactly. That 48% surge in new bookings tells you exactly where that segment is headed over the next 12 to 18 months.
And they specifically highlighted adding a new customer in defense satellite communications for RF filter products. What exactly is an RF filter doing in a satellite?
So space is an incredibly noisy environment when it comes to the electromagnetic spectrum.
It's lots of interference.
Tons of it. You have solar radiation, overlapping communications from other satellites, potential terrestrial interference. An RF or radio frequency filter does exactly what it sounds like.
It filters it out.
It filters out all the unwanted frequencies and noise, allowing only the specific desired signal to pass through.
Which I imagine is pretty important for the military.
Crucial. In defense communications, where secure, unjammed transmission is everything, those filters have to operate flawlessly.
Yeah.
We're talking extreme temperature fluctuations, high radiation environments.
So again, a highly engineered, mission-critical component with near-zero tolerance for failure.
Exactly. Same thesis as the medical devices.
Okay, so the diversified side of the house is acting like a high-growth tech firm. High stakes, high margins, sticky contracts. Let's pivot and look at the remaining 41% of their revenue.
The legacy business.
Right, the transportation segment. Sales here modestly declined by 2% year over year.
Which really isn't surprising given the broader...
And CTS is heavily tethered to those production volumes.
Yeah, so a 2% decline is just gravity doing its job in a cyclical industry.
But they aren't exactly struggling either. They pulled in $163 million in new wins just in Q2.
Including a significant new sensor award with a North American OEM.
Yeah, and a new EV customer. They are currently sitting on $1.2 billion in total booked business in transportation. So let me try out an analogy here.
Go for it.
I keep hearing analysts call the auto segment a cash cow, but I don't think that captures the dynamic. It feels more like a booster rocket.
A booster rocket. Go on.
Well, the legacy auto business is the booster rocket. It's massive. It requires a lot of volume. And right now, it might not be growing very fast, but it provides the massive initial thrust.
A cash flow and the manufacturing scale.
Exactly. Meanwhile, the diversified segment is the actual satellite. The auto business is funding the R&D and providing the financial stability so that this high-margin, sticky satellite business can, break out of the atmosphere and reach orbit. Does that $1.2 billion backlog act as the fuel for that transition.
I love that. That is a much more accurate way to look at it than just calling it a cash cow.
Right.
A backlog of $1.2 billion gives management unparalleled revenue visibility. When you know you have $1 billion of future business locked in, even in a flat macro environment, it de-risks the entire operation.
Because the baseline is secure.
Right. It allows leadership to confidently allocate capital toward expanding the diversified side without constantly worrying about keeping the lights on.
That makes total sense.
And importantly, within that auto segment itself, they are pivoting toward electric vehicles. EVs require a much higher density of the exact sensors CTS specializes in.
So even the booster rocket is getting an upgrade.
Precisely.
Now, let's trace this product mix shift down the income statement, because the margin expansion we are seeing here is staggering. Adjusted gross margin expanded by 270 basis points year over year.
Hitting 41.5%.
Yeah, and adjusted EBITDA margin hit 25.4%, which is up 240 basis points.
In hardware manufacturing, moving your gross margin by 270 basis points in a single year is monumental.
That's not just cutting back on office supplies.
No, that doesn't happen just by negotiating slightly better shipping rates or finding minor operational efficiencies. That is the mathematical proof of your booster rocket analogy.
Because the mix is changing.
Yes. As a larger percentage of your overall sales comes from high-margin medical and defense tech, rather than high-volume, lower-margin auto parts, your overall profitability ceiling lifts.
And they're converting that margin into serious liquidity, too. Operating cash flow was $33.4 million for the quarter.
And free cash flow hit $28.8 million.
Which is up from $25.1 million in Q2 of last year. Plus, they returned $15 million to shareholders year-to-date through buybacks and dividends.
Don't forget the balance sheet.
Right.
Yeah.
$108 million in cash against only $55 million in long-term debt.
Having a net positive cash position of that magnitude is a massive strategic weapon in this interest rate environment.
Because borrowing is so expensive right now.
Exactly. They don't have to go out and borrow at elevated rates to fund their growth. That $108 million is dry powder. They can use their internally generated free cash flow to hunt for strategic mergers and acquisitions.
To accelerate that 59% diversified revenue even higher.
You got it.
Here's where it gets really interesting, though. Because as much as I love this growth story, if you dig into the footnotes and the adjusted earnings reconciliations, there's a very specific detail that caught my eye.
Oh, the FX bump.
Yes. Q2 2026 foreign exchange favorability and customer reimbursements added 0.57 cents to that EPS number. Now, the total adjusted EPS was 0.74 cents, so I have to play devil's advocate here.
Sure.
Is this 270 basis point margin expansion truly structural, or is it being artificially padded by temporary FX tailwinds and one-off customer reimbursements?
You are absolutely right to isolate that variable. Currency fluctuations are a macroeconomic reality. They are not an operational achievement.
Right. They just got lucky with the exchange rates.
If the dollar weakens against the euro or the yen, foreign sales translate into more dollars, boosting the EPS. But let's run the math to see if the core thesis holds up.
Let's do it.
If we completely strip out that $1.77 bump from FX and customer reimbursements, the core operational adjusted EPS drops to $0.67.
Okay, but last year's EPS was 0.57 cents.
Right. So even if you remove every single penny of the macroeconomic padding, they still delivered a 10-cent year-over-year increase in core operational EPS.
Wow.
That is roughly a 17% organic growth rate on the bottom line. So to answer your question, yes, the headline number was helped by FX, but the underlying engine, that margin expansion from selling more medical and defense components, is structurally sound and compounding.
Okay, that definitely clarifies things. The mix shift is the actual signal. The FX is just a temporary amplifier.
Well said.
So we've validated the margins and the balance sheet. Now we have to look forward. Because no management team raises full-year guidance without simultaneously laying out the potholes they expect to hit.
Yeah, and CEO Pratik Trivedi was very clear that while his focus is on long-term value creation via the diversification strategy, the company is operating in a highly volatile macro environment.
So what does this all mean? They stated their macro assumptions for the rest of the year. They expect light vehicle production to remain flat or slightly down.
Which completely explains their urgency to lean on commercial vehicles and the diversified segment.
Right. But beyond just end market demand, they explicitly called out external risks. They are monitoring geopolitical conflicts, changes to the USMCA trade pact, increased tariffs, and inflation in raw materials.
And they specifically highlighted inflation in precious metals, petroleum-based products, and rare earth elements.
Yeah, the rare earth elements piece is huge.
If we connect this to the bigger picture, the mention of rare earth elements is arguably the most critical geopolitical variable for hardware tech right now.
Why do rare earths matter so much to a sensor company, though?
Because you literally can't build these highly engineered components without them. Things like neodymium or samarium cobalt, they are essential for creating the powerful permanent magnets used in precise actuators and advanced sensors.
And the supply chain for that is pretty concentrated, right?
Extremely concentrated globally, particularly when it comes to mining and processing. So any flare-up in geopolitical tension or a shift in trade policy can immediately choke off supply.
Or trigger massive inflation in the cost of raw goods. And just to be clear, for you listening, we don't take sides on the politics of trade wars or tariffs on this show. We are strictly looking at the operational math.
Right, it's just a numbers game at this level.
Exactly. If a new tariff is slapped on a rare earth metal that's imported for a medical sensor, CTS has a math problem. They either have to absorb that increased cost, which compresses those beautiful gross margins we just talked about, or they have to pass the cost on to their customer.
And this brings us to what I think is the most insightful takeaway of the entire earnings report. Management is fully aware of these supply chain vulnerabilities. They are actively watching the inflation in precious metals. They see the geopolitical instability.
Right.
And yet, despite explicitly outlining all these heavy macroeconomic risks, they still chose to increase their full-year earnings guidance.
Wait, I see what you're saying. That is the ultimate proof of pricing power.
Exactly. It's the real aha moment of the quarter. If a company raises guidance into the teeth of raw material inflation, it means they are supremely confident that they can pass those costs along to the customer without losing the contract.
Because we go right back to the FDA regulations and the defense satellite RF filters.
Everything connects back.
When your actuator is the single point of failure in a life-saving medical device, or your filter is the only thing keeping a satellite's communications from being jammed, the customer will accept the price hike.
They don't have a choice.
The mission-critical nature of the product literally inoculates CTS against the margin compression that a normal commoditized auto parts supplier would normally suffer.
You've hit the nail on the head. The switching costs are too high and the stakes are too great. The customer absorbs the tariff because they have no other viable choice. This raises an important question, one that you should really be mulling over as you look at how the market categorizes stocks in your own portfolio.
I like where this is going.
Wall Street has traditionally assigned CTS the valuation multiples of a cyclical auto parts supplier tethered to the boom and bust cycle of global car production.
Which makes sense historically.
Right. But with 59% of their revenue now coming from resilient, sticky, high-margin sectors,
Right.
and a massive $1.2 billion backlog acting as a stabilizing booster rocket, plus a balance sheet primed for acquisitions, is the broader market fundamentally mispricing this company?
That is the big question.
Are we watching a legacy auto supplier transform into a diversified industrial tech powerhouse right before our eyes?
It is the defining question for the stock moving forward. If the business model is structurally changed, eventually, the valuation models will have to catch up.
It's a fascinating pivot to watch.
It really is. Thank you for joining us for this deep dive. Make sure you hit follow on the show for your daily dose of rapid fire earnings coverage so you never miss the underlying mechanics behind the headline numbers. We'll see you next time.